All right, the event of the week, no doubt, is the Fed's rate decision with the 75-point basis hike looking like a lock at this point. On top of this, results season continues and Friday's payroll report also on the docket. So how should investors be positioned? We're joined by Mahoney Asset Management CEO Ken Mahoney. Ken, good to see you, sir. We'll get into all of that in a moment. But first, what do you make of the fact that the Dow having its best month since the 70s?
And you think about, like, coming to October's, it's always spooky, right? I mean, nice theme there. I'm missing my tie. Sorry about that.
Me too.
But, you think about the October, 1929 stock market crash, October 1987 stock market crash. And of course, 2008, that October, kind of too big to fail financial crisis. So we've had a lot of experience in crashes in October. But I think what set the stage for this October was a really nasty sell-off in September. It actually took out some of the losses prior to it. But it's nice to see, again, we'll see where we go from here, but it's nice to see all these kind of goblins that go around in October. It's nice to see the bulls jump on board here and really come back after a really rough September.
Now, Ken, we have seen this enthusiasm before, followed by the wind sort of coming out of their sails once they sort of passed through the comments that came from Powell later. And you talk about focusing on the commentary, not just the 75 basis point hike that we're expecting. What are you looking for, perhaps, in the comments?
So I think he's going to be belligerent again. That's my best word I have for him since the Jackson Hole conference about rates. Now, a couple of weeks ago, it got out there that maybe they'll pivot, maybe they'll pause. And I think that's why the market's rallying so much. And this could be, unfortunately, a replay from just a quarter ago where we had the same thing, that earnings came to the front burner. Some of the problems we had about inflation, the Fed went to the back burner and the market rallied in absence of that. We've had a quiet period, a dark period for the Fed, which is nice because it's nauseating 19 speeches a day by the Fed governors. It's nice to actually have a little break here from that. But on Tuesday, Wednesday, 2:30, the question answers, that's where the rubber's going to hit the road. And my guess is not as lot has changed as far as inflation data for them to come off this kind of belligerent stance. So we may wind up giving back some of this October gain if, in fact, the Fed is not looking to pivot anytime soon.
I believe we get no economic projections in November, so added emphasis on the commentary from Powell. Over the weekend, Goldman added 25-point hike to their projection, so now it's 75, 50, 25 in February, 25 again in March with a terminal rate around 4.75 to 5. Is that how you see it?
Yeah, I could go there. Look, the competition for stocks, I mean, look, we all know higher rates, it affects credit cards, equity lines, mortgages, and so forth. But the bottom line is it's competition of stocks. I mean, a year ago, it's trading at 0.5%. What is it, almost look at 4.5% now, the 2-year Treasury? That starts bumping up. That's huge competition for stocks, especially those big pension fund managers, institutions that manage tens of billions of dollars. Their bogey is 6%, and they're going to get a chunk of that at 4.5%, 5%. They probably don't want to take too much more risk after that.
And I want to ask you about energy prices. It's the outstanding performer of the day, but also for the month as well. But obviously, this is an issue that's been going back and forth. What are your expectations here and how much that's going to weigh on the inflation picture?
Right. So we've been in this kind of trading range, I would say, from $85 to $89 a barrel for the last several weeks, though the individual stocks lifting. Of course, your favorite ETF, XLE, lifting this month. Exxon today was higher, a little bit lower about the windfall tax. It's kind of strange when oil is your leader. You technically, again, I really like to see when technology is leading or other sectors, because when energy is leading, that's also hurting the consumer. So again, there are components of the Dow Jones, components of all the different indexes. But there's a double-edged sword to that one, right? The other side of it, it hurts consumers. It acts like a foreign tax or some type of tax to the average consumer dealing with this.
So given the context, the setup that you just laid out, what's your advice to investors going forward?
If you had a nice profit in October, there's nothing wrong. You don't have to be a hero here. Try to take some money off. We're still in a bear market. It's a nice bounce that we've had. I hate to throw a wet towel or wet blanket on it, but if you look at a chart, we're still trending downward with a nice little pop this month. So if you have some gains this month, nothing wrong with cultivating some of them. We don't know exactly what the Federal Reserve is going to do. The expectation has been that they're going to pivot and pause. I don't see that. I see them coming back and being kind of aggressive, and perhaps Goldman's right, and maybe it could be worse than that. But you start getting to a 4.75 to 5% Fed fund rates, that's not a good setup for stocks.
I mean, and speaking of stocks, I mean, it's been a bit of a mixed bag when it's come to earnings season here. What's your take on your expectations for how we should really be looking at earnings season, given some of the backdrop of what we're dealing with right now?
Well, last week it reminded me of the Survivor TV show, right? It's like, okay, someone has to go home, right? Someone's off the island, and that was Meta. They sent them off the island. Then it was Amazon. It was Microsoft. I mean, seriously, it was a tough week. It's amazing that the market held up so well. And the lone survivor, Apple. So Apple did pretty well again, buying back shares, EPS, and so forth. So, that's her leadership, and each and every one of them, unfortunately, had a negative result. But we did see some money go into like Honeywell and some of these industrials, while the Dow's outperformed the S&P when the S&P's outperformed the NASDAQ. The NASDAQ's still not into this winning streak, so to speak, very, very slightly. But last week, definitely expectations were low coming into the season, no doubt. But unfortunately, we saw a lot of the tech need, including Google, Amazon, Donner, Blitzen, CommonQ, all these different big companies really saw themselves down 10, 15% after hours. So it was not a good place to be last week.
And they took another hit today. And the NASDAQ is up, albeit less than 4% compared to the almost 14% for the Dow. Could anything encourage you to get back in on tech in the short term?
No, it's going to take a couple of quarters. Right now, anytime a stock does that and they give guidance lower, analysts continue to downgrade. Then as an investor, you find yourself like in quicksand. That's where we are. Honestly, to see the Googles and Microsofts and those type of names again, yeah, investors probably have to see 2 or 3 quarters of positive growth and some type of positive commentary of guidance. But until that time, I think it's going to be dead money or worse, like I said, quicksand type of money.
Yeesh, dead money or worse, quicksand. Strong words there. We do thank you for joining us, Ken Mahoney, for your commentary. Thanks so much.